All right, today we're going to tackle a really important tactic for any Forex trader out there, hedging. We're going to break down exactly how you can use it to kind of build a shield against the market's wild swings. So, let's just dive right in.
You know that feeling, right? You have a great position, everything's looking good, and then bam, some unexpected news hits and the market just goes haywire. So the big question is, how do you protect your hard-earned capital from just vanishing in a flash?
Because let's be honest, the Forex market can often feel like a total roller coaster. I mean, one minute you're climbing high, the next you're plunging, and it's all happening with feels like lightning speed.
And look, this isn't just a feeling, it's a hard fact. Major news or big economic events can cause some really extreme, sudden volatility. This creates a huge risk, right? A profitable trade can flip into a significant loss in just a matter of seconds if you're not prepared for it.
So how in the world do we deal with this roller coaster? Well, this brings us to the core of our explainer today, Forex hedging. You can think of it as the safety harness on that crazy ride.
At its heart, hedging is all about protection. The goal isn't to make more money, but to protect the position you already have from a sudden nasty move against you. And that analogy is just perfect. It really is like buying insurance for your trade.
Okay, so let's boil this down. The most crucial point to get is that hedging is purely about managing risk. You can either take an opposite position to completely neutralize your risk, or you can use financial tools called options for more flexible, kind of partial protection. Just remember, its purpose is defense, not offense.
So let's look at that first method, which we can call the perfect shield. This is your all-or-nothing total safeguard.
How it works is actually pretty straightforward. If you're long on a currency pair, meaning you bought it, you just open a short position for the exact same amount. If you're short, you open a long one. The two opposing trades just completely cancel each other out. So what's the result? Well, while that perfect hedge is active, both your potential profit and your potential risk drop to absolute zero. You're completely shielded from any market movement, doesn't matter if it's good or bad. A really great way to think about it is like you're literally hitting a pause button on your trade. You're not closing it out, you're just freezing it in time. This is awesome for when you want to wait out some intense volatility, like a big news announcement. Once the storm passes, you can just remove the hedge and get back to your trade.
But, okay, what if you don't want to hit pause? What if you want protection from the downside, but you still want to be able to profit if the market moves in your favor? Well, that's where the insurance policy hedge comes in.
This second strategy, called an imperfect hedge, uses these financial instruments called options. Now, an option is basically a contract that gives you the right, but not the obligation, that's key, to buy or sell a currency at a set price. This gives you a safety net while keeping your profit potential wide open.
Let's walk through a real-world example to make this stick. Imagine you're shorting the British pound against the US dollar. You're betting it's going to go down. But there's a huge vote coming up that could send the price soaring against you. To protect yourself, you buy what's called a call option, which gives you the right to buy the currency at a set price later on.
So what does that actually do for you? Well, it quantifies your maximum risk. In this scenario, your potential loss is now capped at exactly 50 pips, which are those tiny units of price movement in Forex plus whatever the option itself cost you, which is known as the premium. You've basically just created a hard ceiling on how much you can possibly lose.
And this is the real magic of the option. Even if the pound skyrockets way up to, say, 1.4375, your option gives you the right to buy it back at that much lower price of 1.4275 to cover your short position. It is your ultimate escape hatch from a catastrophic loss. It's fantastic. So we've seen two really powerful ways to protect our trades, but it is so vital to remember that this protection is never free. There's always a trade-off.
And that trade-off becomes super clear when you put them side by side. With the perfect hedge, yeah, your risk is zero, but the cost is any potential profit you're giving up. With an imperfect hedge, you get to keep your profit potential, but the cost is that upfront premium you have to pay for the option. You know what it all comes down to it? This quote from Investopedia really just hits the nail on the head. Hedging is a fundamental tool for managing risk, not for generating profit. It's a survival strategy. And yeah, it costs something, whether in fees or lost gains, but what it buys you is control and stability.
Which leaves us with a final and I think crucial question to think about. Hedging definitely introduces costs, but it also gives you a safety net and can prevent absolutely devastating losses.
So you have to ask yourself, in the crazy volatile world of trading, is that peace of mind worth the price? Something to think about. Thanks for joining me.